Welcome to Heart of Economy. Today, we're going to talk about how a piece of gold, a bullion bar, or even just a customs code can unleash massive global consequences. Gold is not just an investment vehicle. It is the oldest monetary asset in history, a symbol of wars, peace, empires, and collapses. And the development we're going to discuss today arrived so quietly, yet its impact may be talked about for years to come. The United States has taken a step that could reshape not only the gold market, but also the global financial system, geopolitical balances, and perhaps even the future of monetary order. If you're ready, let's begin. The surprise customs move, an unexpected tax blow. On July 31st, Customs Letter, a ruling letter, was issued by the U.S. Customs and Border Protection. This letter states that 1 kilogram and 100-ounce gold bars imported from Switzerland will now be subject to taxation. Now, pause and think for a moment. Gold, classified as bullion or a precious metal, has traditionally been exempt from tax, but not anymore. This decision is hidden within just a few lines of a letter. Yet those few lines are shaking a market worth trillions of dollars. Let's remember, Switzerland is home to the world's largest gold refineries. Over 90% of the world's refined gold passes through Switzerland. Now that gold will be taxed when it enters the US. But why? That's the real question. And the answer isn't just in tax regulations, it's rooted in a global strategy. Because when you combine this decision with rising demand for gold, central banks requesting physical delivery, and the West's monetary system showing signs of fragility, it becomes a signal. It reminds us of something. Before a country makes a major shift in its monetary system, it first secures control over key resources. This might just be such a move. Do you know where the first impact of this decision is being felt? In London. Yes, because the heart of the gold market lies with London's bullion banks. There, the EFP, Exchange for Physical, system allows for futures contracts to be settled with physical gold. But now there is a problem. If gold can no longer enter the US, or if it enters at a much higher cost, EFP positions must be closed. This triggers a massive funding demand. London's gold banking system loses its collateral. This creates financial stress, possibly even a crisis. The spread between COMEX, gold futures, and spot gold prices is now widening into a chasm. Just a few months ago, this development was seen as merely a possibility, but now it's a reality. And remember, the gold market is a paper gold system with very little physical delivery but enormous trading volume. The gold that changes hands on paper is dozens of times greater than actual physical stock. Even a small disruption in supply and demand can cause a cascading crisis. And that's exactly what we are witnessing. Could the US Customs move be initiating a geopolitical liquidity test? The gold market doesn't run on physical gold alone. Many investors and banks use the same gold multiple times as collateral in various transactions. This is known as rehypothecation. But Basel III rules have already been pushing banks to hold more physical gold and rely less on paper transactions. Now, with the US new tax move, the circulation of physical gold becomes even more difficult. This could trigger the withdrawal of pledged gold from the system, a process called the hypothecation. What does this mean? It means the system might show gold on paper, but the actual deliverable gold shrink. And this doesn't just affect the gold market, it shakes the very foundation of the credit and collateral system, because the balance sheets of banks are often filled with assets that appear to exist but are physically unreachable. A collapse in the system could impact major hedge funds, mining companies, even central banks. And let's not forget, what triggered the 2008 financial crisis was the breakdown on collateral chains. Now a new question rises. Will they only affect gold? At the moment, the ruling only applies to 2 customs codes for gold, but this raises speculation about other metals being next in line: silver, palladium, platinum. If this is a test, and it succeeds, the system may soon be reshaped for other metals too. And why not? Today, metals are not just investment tools, they are crucial to the energy transition, green technologies, and defense industries. This taxation regime could be the start of a new era in which the US makes critical minerals a strategic priority. Perhaps this is not just a tax, but the first step in a strategic resource nationalization. There is more than just economics behind this decision. It smells of geopolitical strategy. Switzerland's refining power is being undermined. London's influence on gold pricing is being weakened. US-based COMEX and domestic refiners are being brought forward. What does that mean? It may mean that the center of gold is being drawn directly into the United States. The power to determine global pricing might soon concentrate in New York. This isn't a commercial decision, it's a move in global power game, and the real question is, why did America act now? Answer: because the time was right. Central banks around the world are diversifying their reserves. Demand for gold is rising. Countries like China, Russia, and India are positioning gold as a strategic asset, and the US could not afford to remain silent in this new order. This move isn't just an economic repositioning, it's a struggle for monetary supremacy. Since Bretton Woods, gold has remained a passive figure in the face of the dollar, but now America may want to reintegrate gold into its own system and rewrite the rules of the game. What's critical is this: if pricing power shifts to the US, it won't just affect markets, it will affect nations. Because whoever controls the price controls the power, and the price of gold can determine a country's reserve value or even its diplomatic leverage. Now, we come to the most intriguing theory. The US Treasury still records its gold reserves at $42.22 per ounce in its official books. That's just 1.5% of gold's actual market value today. Currently, gold trades at around $800 per ounce. At the new 39% tax, and it could push the effective value up to $4,726. Now hold on tight. If those reserves were valued at market prices, the US Treasury would instantly gain $1.2 trillion in value. What does that mean? This is not just an accounting adjustment. It would directly impact the federal budget, reducing the need for new debt. And more importantly, the Treasury could gain maneuvering room without needing the Fed's aggressive interest rate policies to fight inflation. So what could this be used for? Perhaps to fund social spending. Perhaps to reduce bond purchases by the Fed. But more likely, it may be a silent preparation to open a new chapter in the financial system. The vast gap between gold's book value and real value could one day turn from a mere accounting anomaly into a political tool. And maybe this new tax is the first step to legitimize that shift. Now, we are left with a small but critical question. Could there be a hidden thought behind all these moves? What if that gold isn't really there? That sentence alone could shake the entire system, because even central banks now demand physical delivery. They are turning away from paper gold and toward real gold. Since 2020, countries like Germany, the Netherlands, and Austria have repatriated their gold reserves from New York. It was a silent declaration of a trust crisis. Today, investment funds wealth managers, governments, and central banks all want gold they can physically touch. And if a significant portion of the US reserves only exists on paper, then these recent decisions suddenly make much more sense. Could this new taxation system also be a way to slow down, delay, and restructure deliveries? No one will answer that question directly, but in financial history, some truths are only understood through the questions they raise, and this is the most fundamental one. Is the gold really there? Dear listeners, today we didn't just talk about the customs tax. We explored the strategic importance of gold, the hidden veins of the financial system, how global power is shaped through gold, and the bold moves of the United States in this game. What happens today shapes the system of tomorrow. And the world of finance is no longer just numbers. It's a chessboard where grand games are played. The prices move silently, but their impact shakes everything. Remember this, gold is not a value. Gold is a definition of value. And whoever controls that definition controls the system. If you don't want to miss the kind of strategic financial analysis, subscribe to Heart of Economy. Don't forget to turn on notifications, because the next move might directly impact your financial future. I'll keep telling the story. All you have to do is listen.